Suzanne, thanks for joining me today to talk about debt restructurings from the perspective of a borrower. And this is an area where companies are not dealing with this every day, and yet it's not infrequent, so I know we get a lot of questions.
Yeah, we do get a lot of questions, and it's important to get this right because it impacts a lot of things. So it could impact transaction costs, unamortized costs, interest expense, and even cash flow statements and disclosures as well.
Okay, so then Suzanne, before we get into the accounting, how do you even know if you have a debt restructuring?
Anytime you make any sort of change to any debt, I would ask two questions. Did the change impact the cash flows in any way? So timing, amount, etc. And is the lender the same before and after that change? So if the answer is yes to both of those, then you would apply the debt restructuring guidance. So a few things to keep in mind. Legal form doesn't really matter here. So you could actually go out, issue new debt, get cash, and take the money and pay off the old debt. So you do legally extinguish the old debt, but you would still be in the debt restructuring guidance if the lender was the same in the old debt and the new debt. And that's pretty common when you're dealing with syndicated debt. So what you have to do with syndicated debt is actually take the lender listing from the old debt, the new debt, line it up, and then any that are common that kind of roll over to the new debt, you'd have to apply this guidance.
Okay, so basically any changes to debt, you should at least be thinking about whether or not this applies. And I guess now that we know if we are in a debt restructuring, then if we turn to the screen and take a look, you can see there's a lot of different models depending on type of debt and the type of restructuring.
Right.
And so I guess from your experience, where do you see the most restructurings occur and where are we getting the most questions?
I would say we get the most questions on the term debt restructuring, so non-troubled. So to start off, when you have a non-troubled debt restructuring, you would do a test called the 10% test, and it will tell you whether the debt should be accounted for as a modification or an extinguishment.
And I know from talking to you that the 10% test is probably where we get most of our questions.
Yeah.
But before we jump into that, can you just explain the difference in the accounting between a modification and an extinguishment?
Yeah, sure. So if you have a modification, the carrying value of the debt is not going to change. So you leave it on the books, the unamortized costs and everything. You capitalize your creditor fees and you expense your third-party fees. Now, if you have an extinguishment, it's kind of the opposite. You do write off the carrying value of the old debt. You bring the new debt on the books at fair value, and then you would expense the creditor fees and capitalize the third-party fees.
Okay, and then similar to what you were just talking about with respect to getting into the guidance, you can't just go from the name and say, oh, I paid off my debt, it's an extinguishment, I changed my debt, it's modification, but you have to do this 10% test. So what can you tell us about that?
Right, so the 10% test, basically what it does is it compares the cash flows of the old debt and the new debt, as you see here on the screen. And if the change in cash flows is 10% or more, it's an extinguishment. And then of course, if it's under 10%, it's a modification. So I know I make it sound pretty easy,
yes.
But like I said, we do get a lot of questions, so I want to cover a few. The first one I want to cover relates to prepayment options. So prepayment options are call options, and they're very common in variable rate debt. You see it a lot with syndicated debt. So the 10% test has specific guidance that says if debt is callable, then separate cash flow analysis should be done assuming exercise and non-exercise of the call. And then you should use the scenario that generates the smallest change to get your accounting answer. So wanted to talk about this one because sometimes companies initially overlook that guidance about the call option. So what they'll do is they'll just run a cash flow scenario out to contractual maturity, and they won't consider the prepayment option scenario. So when you do that, sometimes you end up with the wrong answer. You might think, usually it's you end up thinking you have an extinguishment when you really don't, if you had considered the prepayment option. So I want to just go through this a little bit more because we do get questions a lot with an example. So you see the assumptions here on the screen with our example of the old debt and the new debt. The key point here is the old debt and the new debt are both prepayable. And let's just, for the example, say it is not a troubled debt restructuring. So we're doing the 10% test. So on the screen here, you'll see the first cash flow scenario, the first 10% test. So this is the one where we run the cash flows out to contractual maturity. So you don't see all the work behind this, but trust me, it's a lot of work. So you schedule out all the cash flows of the old debt, discount them back at their own effective rate. And then the new debt, you schedule the cash flows out based on its contractual terms, but you discount it at the effective rate of the old, then you add in the lender fees and come up with your change. Now you see here on the screen, the change was 13%. So that's an extinguishment. So like I said, some people stop here, and if they would have stopped here in this example, they would have accounted for it as an extinguishment. But what I want to show is if you go to the next screen, you'll see the cash flow scenario where we run assuming prepayment. So it's a lot simpler, first of all, and since the debt, both the old and the new debt, is prepayable at any time, we're just assuming immediate repayment on day one. No interest, no present valuing, nothing, a lot simpler. And you see here now the cash flow change is only 1%, so it's a modification. So what I wanted to point out is, one, don't overlook that, but two, if you did the prepayment scenario first, which I highly recommend, and you get to an under 10% change, then you can just stop. You don't have to do all the work on the other one because it's not going to give you a different accounting answer.
There's just a good reminder that you really need to make sure you know all your terms before you start doing this test.
Definitely.
Yep.
Definitely. So another area that I want to highlight in the 10% test relates to principal changes. So that is when you do a modification or a restructuring, but you change cash, like you either get more money from the lender with the restructuring, or you pay off a portion of your debt and restructure at the same time. What we see sometimes is companies aren't accounting for this principal change in the 10% test, and you really need to do that. Otherwise, you're not really comparing apples to apples. So principal increases would be shown as a day one cash inflow for the new debt, and decreases obviously would be a day one cash outflow. So if we just revisit my example one more time, so let's assume everything's the same, except with the restructuring, I got an additional $10 million. So now my principal is 15. So you see the cash flow scenarios here on the screen that I put a $10 million day one inflow for the cash I got, and I actually end up with the same change that I had for the prepayment option, which is 1%. If I take that 10 million out, if I forgot to put it in, then my change would be a lot different. It would be an extinguishment. So it's just really important to keep those in mind when you're doing the test.
Good, very helpful reminders. And I guess, Suzanne, then just to wrap things up today, you know, another place we get questions is on the cash flow statement.
Yeah.
So can you just give us a quick summary of the guidance there?
Sure. So for an extinguishment, all your fees that you pay are going to be financing cash flows. For modifications, all your creditor fees are going to be financing cash flows, but third-party fees are going to be operating.
Okay, so definitely another reason it's important to know if you have an extinguishment or modification.
Exactly. Yep.
Good. All right, thank you very much, Suzanne. Very helpful reminders.
Thanks.